what are you paying attention to in the broader macro environment that's helping you gauge sort of where you see things going?
Sure. I think I start with what is the yield curve doing. So I'm a big fan of the Treasury yield curve. Most of the time, it's a really boring thing to care about. Most people don't care about it. But when we get into dicey times, it's a really important metric to watch. So when we see yield curve inversion and the 2-year, 10-year curve has been inverted for quite some time, but what just happened recently is the 10-year minus the 3-month curve has also inverted. Thank you. Thank you, P. I love you too. So what does that mean? So at this point, a recession, I would say, is inevitable, and not just a technical recession, right? We had a technical recession in Q1 and Q2 of 2022, and then we actually had some solid GDP growth Q3, and we might have some solid growth Q4 here, which we're in
Not to
right.
interrupt you, but for the people who've been living under a rock for the better part of this year, can you help define what the technical recession that happened was?
Sure. So 2 quarters in a row of negative GDP growth. That's just kind of what a technical recession is. It usually occurs at the same time that we have a real recession. A real recession is when you involve other parts of the economy. And so the main part that most people are talking about is unemployment. It's hard to have a real recession when unemployment is historically low. It's like literally still sitting at record lows. Now you can divide that up into two camps too. There's one camp that shows that unemployment is still amazingly low. There's another metric that says, well, participation rate is actually lower than it should be. That's not healthy. It's not as good as it seems. The household survey actually looks like we haven't had any job growth for several months. So it just kind of depends what metrics you look at. But what I focus on, and whether this is right or wrong, here's what I do. I focus on the metrics that the Fed focuses on, because the Fed makes policy based on the stuff they focus on. They don't care. We all know that CPI doesn't accurately reflect what real price inflation is, right? We know it's much higher than that. The Fed doesn't care what we think, right? The Fed cares about what does the CPI show, and more importantly, they say, what does the core PCE show? They've said that many times. So I look at core PCE. So core PCE came in for the latest reading was 5.1%, which was higher than the month before and higher than the month before. That still is not looking good. Inflation is still high. So those are what I look at. So bond market tells me a recession is not only inevitable, but now that the 10-year minus the 3-month curve has inverted also, it means that it's increasingly imminent. So it's probably starting anytime soon. I think probably the first half of 2023, we're going to be in a legit, no fun structural recession, and it's going to be unhappy for lots of people. So that's one thing I look at. What else do I look at? What I care about as a hedge fund manager and as an RIA, I want to know, how do I make money off this? How do I preserve my clients' wealth over time? How do we, how do I generate alpha? So what other things I look at? The strength of the dollar, right? The dollar has been really strong this year. It's gone up a ton, but it's backed off recently. In fact, today it's getting kind of hammered again today. Have we peaked? Possibly. Is it likely? I don't know. I think it's probably going to go higher in 2023, but at some point I expect a significant weakness in the dollar, and then we get commensurate strength in risk assets. I think the timing of that all works when the market believes that the Fed is actually going to pause their rate hikes, when we finally peaked and we've reached the terminal Fed funds rate. I think we get a rally in risk assets at that point. That's historically what has happened. It happened way back in 2006 to 2007. I think I've talked about this with you guys before. The markets rallied really hard from basically summer 06 to October 2007. And then the Fed was like, oh crap, there's actual structural problems. The bond market never did signal that we're out of the woods yet. And so stuff started breaking, and then the Fed panicked and started rapidly. That's when they pivoted and started decreasing rates rapidly. And then the floor kind of dropped out under the market, and it was just kind of a disaster after that. And as everybody knows, and then the market ended up bottoming. Stock market bottomed in March of 2009. So this can be kind of a long, drawn out process that's kind of painful. I think we're actually still kind of early in the phase. One other caveat I'll have this is I don't think it's going to last nearly as long as the global financial crisis, because the Fed is moving way faster. They're literally just trying to break things as fast as they can in order to destroy demand and bring inflation down. I think they're going to succeed in destroying demand, and they're going to succeed in destroying the economy, wrecking people, putting people out of business, putting people out of work, and driving prices down that way. I think it's barbaric. I think it's a socialist way to respond to this, and I don't like it. I don't like it that they're doing it this way, but this is what we have. You got to play. You got to play with the cards you're dealt. And so still bearish for now. I think we get a rally at some point, but then I still think there's more pain after that to come. I think Bitcoin, even though it's the greatest asset that's ever been created, and everyone should own some, and everybody should own more of it, that I still think it gets sucked down lower if the floor drops out under risk assets.